The Federal Reserve is leaving interest rates where they are. Rates have been held steady since December. Right now, the benchmark rate is between 4.25% and 4.5%. But President Trump is continuing to push for the Fed to lower them. Before the decision, Trump said Federal Reserve Chair Jerome Powell is not a smart person.
If the Fed would ever lower rates, would buy debt for a lot less. It's a shame. This guy, do you ever have a guy that's not a smart person and you're dealing with him and you have to deal? He's not a smart guy. He's worried about inflation. I said, that's right. If there's inflation in 6 months or 9 months, you lower the rates.
CBS News business analyst Jill Schlesinger is here with me in Studio 57, and the president, not holding back there, is clearly not happy. You've said the Fed is taking a wait-and-see approach. What are they waiting for?
They are waiting to see more data that will emerge as a result of tariffs. So I think it kind of makes sense to people. You say to yourself, if there are tariffs that are on imported goods, those companies that are importing the goods pay the fee. Some of that fee, if not most of that fee, will get passed on to consumers. That's when we will start to see the price of certain items, those imported items, start to rise. And we haven't seen it yet. It hasn't fed through. It takes a while. And we know this from the last era of Trump tariffs, that it took a few months to really filter through. And I think the Fed, unlike what the president said, the Fed doesn't like to do one thing, reverse course, and go back and forth. They really would rather wait to see if we get price increases, if the rate starts to rise more than they want. And then if it doesn't, or if it lasts a few months, they can then resume their idea of cutting interest rates to help the economy.
So right now, then, who is benefiting from rates being held, and who would be better off if they were lowered?
If you're a saver, you are so happy. I mean, let's be honest. If you can open up a high yield savings account online, you can go to one of these aggregators, and all of a sudden you can say, oh my gosh, I can get 3.5%, 4.5% on a short-term CD, a high-yield savings account, a money market account. That's incredible. On the other end of the spectrum, you have borrowers, and borrowers have been suffering. There's no doubt. So if you think about a borrower, you think of, I have a credit card balance. That credit card balance, the average interest rate, is over 21%. I go get a new car, 8%. That's a lot. And then, of course, mortgage rates, which are not directly impacted by the Fed, those are sort of loosely associated with the overall rate situation. And those rates are hovering at just under 7%. So being a borrower, if you're a business, if you're a consumer, if you're the federal government, it is not good when interest rates are high.
So for years, the Fed has been trying to get inflation down to 2%. It's just above that mark right now at 2.4%. Why is that number not close enough for the Fed?
First of all, that 2% number is a fiction. It is made up by the Fed itself. There was a Australian central banker who thought that was about the rate at which there would be an equal opportunity to get a job, and also prices would be under control. But it is not actually some manifesto that has been created. It is a target. So one of the reasons that it has been so hard to get under control is that we had this big inflationary spike after the COVID reopening. And now, as we're at 2.4%, I mean, to be honest with you, if we had settled at 2.3 or 2.4 or 2.2% and there were no tariffs coming, the Fed would be cutting interest rates. So it's funny to see the president prod the Jerome Powell and Fed officials at the very moment that he has created the conditions that prevent them from cutting.
All right, Jill Schlesinger breaking it all down for us on this big day. Appreciate it.
Sure.